$70 billion. Let that number sink in for a moment. Not 70 million, not 700 million, $70 billion. That's the amount Meta's Reality Labs division has burned through since late 2020. And here's the thing that keeps me up at night. That number is still climbing. Every quarter we pour billions more into this bed, and the losses just keep stacking up. To put this in perspective, $70 billion is more than it cost to build the entire Hoover Dam, even accounting for inflation. It's more than the entire market capitalization of companies like Pinterest. It's more than Snap. It's more than Spotify. We're talking about a figure so large that it almost loses its meaning when you try to contextualize it. And for all of this cash, this mountain of capital, what do we have to show for it? On the surface, not much. A few million VR headsets in people's hands. A social platform called Horizon Worlds that most people have never used. Some AI-powered glasses that are gaining traction, but hardly the revolutionary technology that justified such massive investment. This has sparked an absolute storm of criticism. Investors call it a money pit. Tech analysts label it a vanity project. Business professors are already writing case studies about what they're calling one of the biggest financial blunders in technology history. The narrative is simple. A stubborn CEO, that's me chasing a science fiction dream, while the company bleeds billions every single quarter. But what if this isn't a mistake? What if this is actually a calculated, almost brutally rational decision? What if this is the cost of securing our future in a world where the next computing platform hasn't even been invented yet? Today, we're going to explore this question from every possible angle. We'll break down the numbers, we'll examine the strategy, we'll look at the competition. And by the end, you'll have the full picture to decide for yourself. Is this a world-changing bet that future generations will look back on with admiration? Or is it one of the biggest financial blunders in the history of technology? Let's find out. Let's start with the numbers because they're staggering and they need proper context. In the fourth quarter of 2024 just finished, Reality Labs hit a record revenue of $1.08 billion. That sounds impressive until you see the other side of the equation. In that same quarter, our costs were over $6 billion. That's a loss of nearly $5 billion in a single quarter. Think about that. We made $1 billion in revenue and lost $5 billion. The gap between what we're making and what we're spending is almost incomprehensible. When you zoom out and look at the cumulative picture since late 2020, the trend becomes even more dramatic. We're looking at cumulative operating losses that have exceeded $70 billion. Our CFO, Susan Lee, has told investors that operating losses are expected to increase meaningfully year over year. This isn't a situation that's getting better, it's getting worse. The burn rate is accelerating. Now, let me be clear about what Reality Labs actually is, because that's important context. This isn't a single product division like our advertising team or our applications group. Reality Labs is our entire bet on the future of computing. It encompasses the hardware, our MetaQuest line of VR headsets, which are currently the market leaders in virtual reality. It includes the Ray-Ban Meta smart glasses, which are powered by AI and have actually become surprisingly popular. It includes the software ecosystem, most famously Horizon Worlds, our social VR platform where users can create avatars and interact in virtual spaces. But here's where the problem becomes visceral for investors. The public-facing products often feel underwhelming. When we first launched Horizon Worlds, people mocked it. The avatars had no legs. We've since invested billions in upgrading the visuals, creating more sophisticated avatars, building better tools. The platform is objectively better than it was, but it still hasn't achieved mass adoption. It still doesn't feel like the future that justified such massive spending. Our Chief Technology Officer, Andrew Bosworth, even acknowledged this in an internal memo. He said that Horizon Worlds on mobile absolutely has to break out for our long-term plans to have a chance. That's not confidence. That's a CTO saying we have a fundamental problem that needs to be solved. The hardware tells a similar story. The Quest headsets are technically impressive. They're the market leaders. But they're still seen by most people as niche gaming devices. They're bulky. They're uncomfortable for extended use. One Reddit user with a Quest 3 summed it up perfectly. It's a fantastic device, but it kills my neck, and they would only consider replacing a monitor if it were way lighter. This is the core frustration that investors feel. They see tens of billions flowing out the door. They look at the products. They see devices that are improving but still feel like works in progress. They see platforms that are growing but still feel hollow. And they see a massive gap between the cost and the perceived value. For most technology investors, the equation is simple. Investment should lead to revenue growth and eventually profitability. But Reality Labs breaks that equation. We're spending like we're trying to build a global platform, but the revenue isn't following. The growth isn't happening. The adoption isn't there. And then there's the opportunity cost, the invisible elephant in the room. Every dollar spent on Reality Labs is a dollar not spent on something else. It's a dollar not spent on AI infrastructure. It's a dollar not returned to shareholders. It's a dollar not invested in defensive measures around our core business. So the question becomes, what justifies this? What could possibly justify $70 billion of losses with no clear path to profitability? To understand why Meta is making this bet, you have to understand a specific moment in time that changed everything for us. It was 2021, and Apple introduced something called App Tracking Transparency. It sounds innocuous. It was just a change to iOS that added a pop-up asking users if they wanted to allow apps to track their activity. Sounds simple, right? Most users said no. And when they said no, it fundamentally broke our business model. Here's why this matters. Our entire advertising business is built on data. We know what you like. We know what you search for. We know what you click on. We use that data to sell hyper-targeted advertising to businesses. That targeting is what makes our ads so valuable. When Apple blocked that tracking, advertisers suddenly couldn't reach the right people as effectively. Ad effectiveness dropped. Prices dropped. In February 2022, our CFO at the time estimated that this single change would cost us over $10 billion in lost revenue that year alone. Our stock plummeted. The market punished us. And that moment crystallized something critical for me. Our company has always been dependent on platforms we don't control. Our entire business runs on iOS and Android devices made by Apple and Google. We're tenants on their property, and they can change the rules whenever they want. Apple did exactly that. With a single software update, our competitor, because make no mistake, Apple as a competitor crippled our business. They collected the tax, they changed the rules, and we had no recourse. We were powerless. That's the moment everything changed for me regarding Reality Labs. This isn't just about building a new product category. This is about survival. This is about independence. As long as we're building on platforms controlled by other companies, we will always be vulnerable. They are the gatekeepers. They can increase the tax they take. They can block us. They can compete with us directly while controlling the platform we're on. It's a fundamentally weak position. So the tens of billions we're spending on Reality Labs isn't really about VR. It's not even really about the Metaverse. It's about building our own platform. It's the cost of independence. It's the cost of becoming the gatekeeper instead of being subject to one. Think about what controlling the next major computing platform would mean. If AR and VR become the dominant way humans interact with digital technology, and I believe they will, and if Meta controls the operating system, the ecosystem, the rules, we would never again be at the mercy of someone else. We would take a percentage of transactions. We would have an unassailable moat against competitors. Other companies would have to build on our platform. They would be the tenants. We would be the landlords. But there's a second part to this strategy, and it's about timing and conviction. I've been consistent about this. Reality Labs is a decade-long investment. We don't expect it to be profitable until the 2030s, possibly later. I'm asking investors to fund a massive speculative R&D project. I often compare this to historical technology investments. When Microsoft built the Xbox, the investment was enormous. People thought it was crazy. Why is a software company building gaming hardware? But Microsoft believed in the future of interactive entertainment and gaming. They were willing to lose money for years to build infrastructure for that future, and they did it successfully. I believe technology moves in cycles. We went from mainframes to desktops, desktops to the web, web to mobile. Each transition took years. Each transition required massive infrastructure investment before the payoff was clear. I'm convinced that immersive, three-dimensional computing is the next step in that evolution. AR, VR, and mixed reality aren't fringe technologies. They're the future of human-computer interaction. And the infrastructure for that future needs to be built now, before the market fully understands it, before the need is obvious. Getting there requires solving enormous technical challenges. Optics, battery technology, processing power, creating an entirely new software ecosystem, building out development tools, recruiting the world's best engineers. This is what accounts for the massive costs. A huge portion of the investment is going into full AR glasses, a product that won't even be ready for a few more years. We're funding game studios to develop experiences for our platform. We're acquiring promising startups and bringing them into the fold. We're releasing new hardware quickly to iterate and improve. It's a strategy of brute force. We're using capital to pull the future forward faster than it would naturally develop. We're betting that if we build it well enough and get it into people's hands early enough, we can shape what that future looks like. Boz called 2025 a pivotal year. He said the work we do this year could determine if this entire effort will go down as the work of visionaries or a legendary misadventure. Those aren't casual words. He understands the stakes. And here's my fundamental belief. The person who builds the next computing platform will define technology for the next 50 years. They will set the standards. They will capture the value. They will be in an almost monopolistic position. If we don't make this bet, someone else will. Maybe it's Apple with their Vision Pro. Maybe it's a company we haven't heard of yet. But someone is going to build the infrastructure for immersive computing. And if it's not us, we lose. We become irrelevant in a world that's moved beyond smartphones and web browsers. So when you ask me if 70 billion is worth it, my answer is, the cost of not making this bet is far greater than the billions being spent today. The cost of being late to this transition is extinction. But here's the thing about having a compelling vision. It doesn't automatically mean the vision is correct. For every argument I've made for this investment, there are equally powerful arguments that this is a colossal misallocation of capital. And these arguments deserve serious consideration because they're not coming from people who don't understand technology. They're coming from sophisticated investors, analysts, and industry experts who understand that sometimes even smart companies make catastrophically wrong bets. Let's start with opportunity cost. This is probably the most straightforward argument. What else could we have done with 70 billion? That capital could have supercharged our position in artificial intelligence. While we're a leader in AI, that 70 billion could have been deployed to acquire top talent, build data centers on a scale that would leave our competitors in the dust, and accelerate our AI capabilities to a degree that would be almost insurmountable for competitors. Instead, we're playing catch-up. We're fighting a two-front war, the Metaverse and the AI race, and we're at a disadvantage on both fronts because we're splitting capital. Alternatively, that 70 billion could have been returned to shareholders, a massive stock buyback, a special dividend. Our first dividend ever was announced in early 2024, a modest 0.5 per share. Meanwhile, we were burning billions in Reality Labs. How many shareholders would have preferred the capital in their hands rather than in a speculative bet on virtual worlds? We could have acquired emerging threats. TikTok was a competitive threat. We could have made a strategic acquisition there if we had the capital available. We could have bought gaming studios on a massive scale to diversify our revenue streams. We could have invested in healthcare technology or robotics or any number of emerging fields. Instead, all of that capital went into a single highly speculative bet on a vision that, frankly, the market is not validating. A platform is only a platform if people use it. No matter how good the technology is, no matter how much capital you pour into it, if people don't want it, it doesn't matter. And the market has responded to Reality Labs with a collective shrug. We sold millions of Quest headsets. That sounds impressive until you compare it to the smartphone market or even the traditional gaming console market. The usage rates are lower than expected. People buy them, they try them, and then they sit on a shelf. They're mostly used for gaming, and even then, by a relatively niche audience. Horizon Worlds, our flagship social VR platform, has been particularly disappointing. It hasn't become a bustling digital city where millions of people spend their evenings. It hasn't become a destination. It hasn't become the future of social connection that we hoped it would be. And here's what's particularly damning. When we look at what's actually succeeding in Reality Labs, it's not the immersive products. It's the Ray-Ban Meta smart glasses. These aren't fully immersive. They're not the Metaverse. They're just glasses with a camera and AI built in. They augment reality subtly. And guess what? They're selling well. Our partner EssilorLuxottica reported that sales more than tripled in the first half of 2025. Think about what that tells us. The product that's succeeding is the one that's not fully immersive. It's the one that enhances reality without replacing it. It's the one that doesn't require you to strap a bulky headset to your face. This suggests something uncomfortable. Maybe the market doesn't want a full metaverse. Maybe what people actually want is lightweight augmented reality. Subtle enhancements to the real world, not replacement worlds. Apple entered this market with the Vision Pro. They focused on high-end spatial computing that integrates with their existing ecosystem. And while it's getting positive reviews, it's not a mass market product. It's expensive. But it's not a failure the way some of our VR initiatives have been. This suggests that the market is telling us something, but we're not listening. And then there's the third counterargument. Maybe I'm fighting the last war. The obsession with owning the platform is a response to the pain Apple inflicted with app tracking transparency. It's a response to feeling vulnerable as a tenant on someone else's platform. But is a closed platform really the right model for the future? Look at what's happening in artificial intelligence. The trend is toward open standards, open source models, interoperability. The big wins are happening when companies collaborate and create standards together, not when they try to build walled gardens. By trying to build a closed metaverse controlled by Meta, we might be repeating an obsolete strategy. We might be building a fortress at exactly the moment when the world is moving toward open systems. As one analyst noted, with Apple dominating spatial computing and OpenAI seizing the AI-assisted narrative, the lack of clarity about Meta's strategic direction is disconcerting as losses pile up. It's a strategic one. If the future isn't a single metaverse controlled by Meta, then everything changes. If the future is distributed AR experiences that work across multiple platforms, then we've invested an astronomical sum in a vision that will never arrive. We'll have weakened our financial position, missed opportunities in AI, failed to defend our core business, and have nothing to show for it. It's about losing a decade of time and capital while our competitors move forward in AI. While market dynamics shifted, while user preferences evolved in a different direction than we anticipated. And that possibility, that this 70 billion bet turns out to be completely wrong, that possibility is very real. Let's talk about the competition because this is crucial context that often gets overlooked. We're not the only company betting on immersive technology. We're not even the only company betting big, but we are arguably the most exposed. We've put our entire company strategy on this one table. Apple came into this space with the Vision Pro. Is it a success? That's debatable. But Apple has several advantages we don't have. First, they have an enormous loyal customer base that will buy whatever they release. Second, they have vast resources to absorb losses on this initiative while their core business remains incredibly profitable. Third, they integrated it with their existing ecosystem, so it's not a completely new vertical, it's an extension of iPhone and Mac. But here's the thing, even Apple's entry into this space is cautious. The Vision Pro is expensive. It's not a mass market product, it's a premium offering. And even Apple, a company with unlimited resources, hasn't committed to losing $70 billion on this vision. Then there are the specialized companies. Valve, HTC, Pico, Microsoft, they're all building VR and AR experiences, they're all taking it seriously. But they're not betting the entire company on it the way we are. And then there's the X factor, the company we don't see coming, the startup that figures out a solution we haven't thought of, the team of brilliant engineers that creates a breakthrough technology that changes everything. That's always possible. That's why betting on one vision is so dangerous. The competitive landscape is fragmented. There's no clear winner yet. And that's dangerous for us because it means we're the company most exposed to being wrong. If someone figures out a way to do AR glasses that's cheaper, more elegant, more practical than what we're building, they win. We've spent $70 billion on the wrong approach. That competitive pressure is real, and it's getting more intense, not less. So, back to the central question. Was it worth it? Is this a rational decision or a historic blunder? Honest answer, as of late 2025, it's still too early for a definitive verdict. But we can map out the two realities we're facing. The path splits into two distinct futures. In one future, this investment will be remembered as a masterstroke. If immersive computing becomes the dominant interface for human-computer interaction, if Meta controls the operating system, if we build the infrastructure for reality itself, then 70 billion and the hundreds of billions more that will follow will look like a bargain. It will be remembered as the cost of building an empire. Future business schools will teach this as a case study in bold, visionary thinking. In the other future, This is remembered as one of the biggest financial blunders ever. The losses are real. Every billion spent on Reality Labs is a billion not spent elsewhere. The opportunity cost is real. The market indifference is real. If competitors develop better, more open alternatives, if the market doesn't want immersive computing the way we envisioned it, if a decade passes and we're still burning billions with minimal revenue, then this becomes a cautionary tale. It becomes Captain Ahab hunting the white whale. Here's what I know. The outcome will be binary. Either this becomes one of the greatest successes in technology history, or it becomes one of the greatest failures. There's no in between. The success of our Ray-Ban glasses suggests there might be a third way, a future of less immersive, more assistive technology that augments reality without replacing it. But that's not the core bet. The core bet is still on fully immersive computing. Ultimately, the verdict depends on what you believe. Do you believe that the march toward immersive technology is inevitable? Do you believe we're early and the world will eventually understand why this investment was necessary? Or do you believe technology must serve existing human needs and the metaverse is a solution searching for a problem that may never exist? That's the question. We've covered the numbers. We've examined the strategy. We've looked at the competition. We've seen the bull case and the bear case. We've defined the two possible futures. What do you believe? Am I playing a brilliant long game? Is this visionary thinking that will define the next 50 years of technology? Or is this a multi-billion-dollar blunder that will never pay off? Do you think AR and VR are inevitable? Do you think someone has to build this infrastructure? Or do you think the market is telling us something and we're just not listening? I'm genuinely interested in your thoughts. Leave your verdict in the comments. Let me know what you think. Reality Labs will ultimately be remembered for. If you found this analysis valuable, please subscribe to the channel. Hit the notification bell so you don't miss future deep dives into the business of technology and the decisions that shape our world.